Thank you. Hey, welcome to NAAIM Confidential, episode number 5. Today we have Rob Bernstein of RGB Capital Group in beautiful but also wet San Diego. I'm Ryan Redfern, the current president of the National Association of Active Investment Managers. Happy to have you here today. Rob is a advisor in San Diego, focused on low volatility trading. I thought the way he thinks about the markets and investing is a really neat twist, because I talked to a lot of people and investors on how they manage money, and there's a lot of variations, and it's going to be fun to explore that with Rob later. So National Association of Active Investment Managers is a group of mostly RIAs that get together to talk about strategy and practice management and all that sort of thing. So it's a great community to learn about that kind of thing. A great place for advisors to learn and grow in RIA. So the NAIM Exposure Index, let's start with that. And this is something you can grab on on Twitter, LinkedIn, and Facebook. The current number is about 93. So it's getting up there. The managers tend to be are a little bit aggressive right now. This market is something to be aggressive in. So, Rob, I think you're a contributor to this index. So, what's your take on it, and where are you now on it?
Yeah, I am a weekly contributor to the index. And first of all, thanks for having me on here this afternoon. Really appreciate it. As far as my contribution, where I stand, we're 100% in on our equity allocations right now. So that's what I report to NAIM on a weekly basis. So we're pretty much in line with where the exposure index is this week. We've been 100% invested for all of this calendar year 2024.
So everyone else is really trying to catch up to you at this point.
Apparently, yes, of course.
Nice. So how do you make that decision for your model? Is there a certain model, and what's the range of that model that you would contribute this number?
Yeah, so again, you mentioned I focus a lot on some low volatility investment strategies. We can get into some of that later. When I focused on the NAIM exposure index, I'm strictly focused on our equity portion of our allocation, and that equity allocation can go from 0% up to 150% invested. So depending on market conditions, we can get levered and get additional exposure when market conditions are favorable. But also, being an active manager, we're looking for downside protection as well, and so we'll layer back and can at times, don't like to, but if market conditions warrant it, we'll be 100% in cash to protect our capital. Perfect.
Well, let's get into your investment philosophy and your background. I don't know if you have slides for that or not, or you can tell us, how did you get to where you are now in managing money, and then what's your investment philosophy, if you want to dive into that.
Yeah, love to. So I did not grow up in this industry. Prior to managing money professionally, I was a technology consultant for Deloitte & Touche for over 11 years, based out of Los Angeles. I was then a technology executive. I was a chief information officer for a real estate land developer here in San Diego for 4 years, right up until 2008. And you could probably imagine, Ryan, 2008 was a really bad place to be. A land developer was a really bad place to be.
Oh yeah.
Our job was to sell lots to home builders, and no home builders were selling lots or buying lots. So we decided to part ways. And one of the things that I realized really quickly was that I was able to do my market research and investment activities during market hours instead of nights and weekends, which is what I had been doing previously. And at that time, I was just managing money for my mom and myself, and we had a really good story to tell. We had all of our capital intact coming through the 2008 financial crisis. And it was really a conversation that I had one night with my mom. We were talking about her friends and my friends and how they were having to make some really big life decisions, right? Either not retire when they wanted to, had to go back to work after retirement, or they had to change the quality of their life because, some of these folks, they had 50% of the portfolio that they had, just the year before. And that's, so detrimental. So
absolutely.
yeah, and that's really what spurred me to get into the financial investment advisory business, is really to be able to help others and hopefully help them avoid that situation in the future.
Nice, nice. So with that background, I imagine that gives you a different philosophy than the traditional advisor as well.
Yeah, for sure. I think, very different than what I consider the traditional advisor, being the buy and hold, or what I like to call buy and
Correct.
hope advisors. But I think I also take a little bit different perspective than even many NAIM advisors. And as we all know, there's 1,000 ways to invest money, and not that mine is any better than anyone else's. I think it just takes a little bit different approach.
Nice.
So happy to share that with you if you want me to.
Yeah, let's dive into your charts and see what you got.
All righty. So, oops, let me get to the beginning here. So, my whole approach, and I think the best way to kind of frame the discussion is to look at this risk reward chart. I think, most everyone in the industry is pretty familiar with this. We've got a measure of volatility on the x-axis. We've got annualized return on the y-axis. And, most investments are going to fall somewhere, in this, what I consider this long-term expected return channel, which is just two parallel lines to this regression line, which is the best fit of these indices. I've got a money market all the way up to the major equity indices. And, as we all know, there's a trade-off between risk and return. But one of the things that I really try to emphasize to my clients is that, we can control risk. We can decide and determine where we sit on this risk scale, right? One way to look at that is we could choose to put all of our money into a money market, and we know we're going to be at this end of the scale, or we could put our money into a more volatile equity index, and we'll experience volatility that's very similar to what you're seeing on the right side of the screen. However, we don't have much control over returns, right? Returns over the last year or two have been pretty good in money markets, right? They've been up in the 4 or 5% range. The decade prior to that, they were close to zero. So we didn't really have any control over the return portion, but we could control where we sit on that risk scale. And so my goal and my job is to really try to achieve these better risk-adjusted returns.
Nice. Lower standard deviation, higher return is the goal.
Yep, and I think most investors, at least the investors I talk to, certainly want to try to achieve that goal, right? There's certainly people out there who really thrive on volatility. Yeah, I get that. I understand that. It's just not the way I was wired. I'm trying to take a very small step out on that risk scale and try to achieve as much return as I possibly can.
Nice, nice. So are you gonna dive into how you get to that point? How you make that arrow go up and to the left?
Absolutely. I'm going to actually try to share some of my secret sauce here. So
awesome. Yeah.
This is, and as I said, this is sort of the portion of the strategies that I run that are focused on this lower volatility, better risk-adjusted return. We do have equity strategies as well, but I'm not going to focus on that today. But what we do is we look at these sectors. Most of them are bond and income type sectors. For anyone who uses Fast Track, these are all available in the Fast Track database. I'll mention the ticker symbols for anyone out there who may want to pull these up. But what I do is I use moving average timing. Typically, the exact moving average doesn't make a big difference. Today, I'm using a 50-day as an example. But generally, with these lower volatility sectors, floating rate, junk bonds, high yield munis, preferred securities, there's a handful of sort of 6 or 8 sectors that I really follow closely. And in certain times of the market, they produce some very good risk-adjusted returns. And because of their low volatility nature, moving average timing works really well with these groups. And what you're looking at on the screen here is the floating rate index that I produce, and it's available in Fast Track, RGB03. This top panel is just a a depiction of that index, price of that index with a 50-day moving average. The bottom panel here is the results of moving into and out of that index based on that 50-day moving average. And when it's out of the index, it's moving into, in this case, just a money market. And so you can see during these big declines, this is a 5-year chart, right? This is the COVID decline. It certainly went down, but we avoided the really big portion of that decline. And then we're able to get back in. And if you follow this routinely, you tend to get much better returns. And not only do you get better returns, so over this 5-year time period, this index produced just under a 5% annualized return. You can see right here. This composite line, which is the result of moving into and out of the index based on that 50-day moving average, returned a 7% return. Mm-hmm. And so the returns are significantly better. But in addition, if we looked at volatility in terms of standard deviation over on the left side here, the volatility of this index was 1.4%. This is a monthly standard deviation number. And the standard deviation of the composite line that we just looked at is 0.61. So it's, half the volatility, mm-hmm. and not quite twice, not quite twice the return, but it's certainly a higher return on lower volatility. And so that's the magic, right? If you can get higher returns on lower volatility, that's going to push you up into that upper left-hand quadrant of that risk reward chart that we were just looking at.
And it looks like in some situations you might actually get close to an S&P type return, an equities type return over high volatility periods without taking the volatility.
Exactly. That's exactly the case. And I actually have a slide later on. I'll kind of show you what that looks like. So I have some other slides here.
Yeah, dive in.
This is junk bonds. They are another great asset class that has those low volatility characteristics. Here holding the junk bond index RGB04 in fast track, went from 4.5 to 6.68. Again, timing it with a 50-day moving average, and the volatility went from 1.86 all the way down to less than 1%. Mm-hmm. So again, higher return, lower volatility. That's the definition of a better risk-adjusted return.
Love it.
Let's see. Here's securitized credit. This is a relatively new asset class, new being within the last 5, 6, 7 years. There have been these securitized credit mutual funds that have come out on the market. And these just got clobbered during the pandemic. I mean, you can see this waterfall decline. But by using this 50-day moving average, it saved us. Mm-hmm. And it kept us out, but got us back in, and we rode this wave up right back up. So again, on low volatility fund, the 50-day moving average timing with a 50-day just won't work on an equity index. It's the low volatility nature of these asset classes that allow this to work in a really positive fashion. So this went from 2% over this 5-year time period up to 7%. And then the volatility, of course, went 165 down to 0.43. So this is really an interesting one, because we got over 3 times the return, and the volatility was a fraction of the original index.
So what could you say? What does securitized credit? What's included in those funds versus the junk bonds you showed previously versus the bank loans? I think were the previous ones. What's the difference in what they invest in?
Yeah, so securitized credit funds tend to invest in these pools of mortgages. It is the big component. They can invest in other assets that are income-producing assets like receivables and other things like that. But the majority of these securitized credit funds tend to be pools of mortgages. Okay. Some of them focus on what they call legacy mortgages, which are all mortgages that were around prior to 2008. Some of them are focused on more recent mortgages, but that's sort of the main asset class or the main asset held inside these funds.
Perfect. No, thanks for clarifying.
Yeah. And what I'll say here, which I haven't mentioned before, is that these indices that I develop are based on mutual funds. They're all comprised of a group of mutual funds that represent that asset class. And the reason I use the mutual funds is, as opposed to ETFs, is the mutual funds have significantly less volatility than the ETF counterpart. So, for example, if you were to take, just a standard standard junk bond mutual fund and compared it to JNK or HYG, the volatility of that mutual fund is, about a third of the ETF. And what makes this work is trying to pull out as much volatility as we possibly can. That's why the mutual funds tend to work a lot better.
Right. And I think a lot of people don't realize that, because they always hear like, well, the ETFs are lower cost. Yeah, but they're also higher risk. Surprisingly, you wouldn't think that much, especially in this bond space and the credit, all this various credit spaces. That definitely is the case. Certainly, I've seen that as well. Definitely prefer the funds. For sure.
And there's a few ETFs that are coming out on the market now that are getting better and better at managing volatility.
Yep.
And I'm really hopeful that if they can get the volatility closer to the mutual funds, I'd much rather use the ETFs. We can trade them frequently.
Right.
But they're just starting to get there. There's some preferred security ETFs that are doing a pretty good job, and there's a few other ETFs out there. But I think we're still a little ways away from that.
Sure. And certainly if you're doing timing on a mutual fund, some mutual fund companies don't like you trading their funds within 30 days, within 60 days frequently. So I think that does solve that problem of making mutual fund managers unhappy. So
exactly. So so just one more slide here. One more example. For preferred securities. This has become one of my favorite asset classes recently. I think there's just a lot of upside potential in this group. They took a big hit during the pandemic. They had a really nice ride up here. They got hit pretty hard during the 2022 sell-off in the stock market. And you can see a lot of these asset classes, they trend in the same direction as equities, right? They're correlated to equities. But what's interesting is that many banking crises that we had in 2023 really sent them back down. And while some of these other asset classes have, kind of breached and moved to some new highs recently, preferred securities still has some room to go. And so I think there's some more upside potential. But again, over this 5-year time period, we got 4% versus 9%. So again, double the return. Standard, volatility from 2.4 down to 0.82, right? So it's less than half the volatility, more than double the return. So it's that kind of combination of looking for those types of opportunities that allow us to get up in that upper left-hand quadrant of the risk-reward chart.
Absolutely. And doing a timing and getting close to 9%, that's not bad at all. That's getting equity-like with a very low risk asset class for sure.
Yeah. And then you mentioned earlier, you asked a question about those equity-like returns. Oops. So this is sort of a comparison of SPY, S&P 500, and the RGB04 junk bond index. So you can see, just even by moving from equities to junk bond mutual funds, you get equity-like returns. It's kept pace. It's fallen off a little bit over the last couple of years, but the volatility is significantly less. And if I was a buy and hold investor, which I'm not, but if I was, I'd much rather buy and hold junk bond mutual funds than the S&P 500, just because of the lower volatility nature of it. But when we apply timing, and this goes back all the way to the beginning of 2000, using that timing over this time period, look what happens just by applying the 50-day moving average. You get certainly equity-like returns for sure.
Yeah. Oh yeah.
and the volatility is, a fifth of that of the stock market. And then the last thing that I do, which I find very interesting, and is applying margin to this. If you can apply margin to a low volatility portfolio, it has some really positive aspects to it. It increases your return potential, but it has a very small incremental increase in volatility. Now, as people probably know, margin will always increase, or any type of leverage for that matter, is always going to increase your risk. But you can see here, the risk compared to, say, the S&P 500 is still about a fifth of that of the S&P 500, and this is a levered portfolio up to 150%. The returns have far exceeded that of the SPY, and you can't really see any, there's not a dramatic increase in volatility between just this junk bond index and the time to margin version of it.
Yeah. And when standard deviation is so low on the pure one, adding the margin doesn't seem to, it doesn't put it up in comparison with the SPY. You're still way less than that, fractional, even with the margin.
Yeah. Yeah.
And to clarify, go ahead.
Yeah, I was just going to say, people don't understand this. They look at me and I go, yeah, we've got some very conservative strategies that use leverage. And they look at me cross-eyed, like, how could that be?
Right.
If you lever low volatility portfolios, this is what you get. If you lever high volatility portfolios, that volatility just shoots through the roof.
Right. And quickly, could you compare margin versus leverage? They're kind of similar, but not. Just for clarification.
Yeah, for sure. Margin is a type of leverage, right? Leverage is just basically using someone else's money to get additional exposure to the market. In the case of margin, what we're doing is, and there's different ways to get leverage, right? You can use the futures market, you can use swaps, but margin is specifically borrowing funds from the custodian and putting those to work in the stock market. We owe interest on the borrowed funds, and when we sell those assets, those funds pay back the margin. Not much different than buying a house with a mortgage. So that's the difference. We're actually there's a transaction of borrowing funds from the custodian.
And how are interest rates affecting that as a strategy right now, with them raising so much in the past really year and a half?
Yeah. So obviously during much of this time period, interest rates were extremely low. For this example that I provided today, I took a 5% interest rate. Prior to the last couple of years, we were borrowing at, close to 2%. Today, it's probably closer to 8%. So I just kind of took the average, but it gives you an idea of what to expect. The higher margin rates are certainly impacting the overall return. It has to, right? But as long as the expected return or the trend of what we're investing in is, my rule is twice the cost of margin. As long as that trend's twice the cost of margin, it probably makes sense to continue to do so. So that's where we're at, and it's a different way to look at trying to achieve equity-like returns on just a significantly smaller exposure to volatility.
No, that's awesome, and definitely something I don't see a lot of people doing. I really don't. You see mostly people trying to time the S&P or the NASDAQ or the higher beta names, and not the low beta names, which is it's an approach that just people don't do. Which I think is so neat to share with people. Did you have anything about what you're thinking now in the economy or along those lines?
Yeah, I'm always thinking about the markets and what might be next. I think this is a chart from JP Morgan. I think this is what gives me hope. It's, I think we're at an inflection point with interest rates. I'll use the Fed as sort of the barometer for this discussion. But obviously, everyone knows the Fed's raised rates. They've basically indicated they're done raising rates. It's now a matter of when do they start decreasing rates. And so there's certainly an expectation that rates are going to come down in the future over the next couple of years. This green line's what the market expects. The blue line's what the FOMC estimates. Doesn't really matter what those specifically say. I think the overall point is that interest rates are expected to come down. We just don't know exactly when, but when they start to come down, most of these categories, as long as the economy stays strong, most of those sectors that we just looked at today are going to be positively impacted by a drop in interest rates, because they're all tend to be bond and income related. So as those rates drop, those prices are going to go up, and we'll have higher rates being paid out, plus we'll have the capital appreciation. So I think there's really a really good opportunity in front of us for some of these lower volatility groups that we looked at today.
Nice.
Yeah, and at any inflection point, I think we're going to see some increased volatility as expectations are set and missed in terms of the timing, right? Oh, they're not gonna drop rates in March. It's now going to be May. Maybe it'll be June. I think there'll be some volatility until they start defining what that path looks like going forward. So that's why I'm hopeful. I'm excited about the opportunity in the future. What scares me though is what's happening in the market, and I'll just use NVIDIA as an example. NVIDIA is just going parabolic. If anyone who follows this, it's up 40% this year, and then we're hardly into February. And I saw some interesting stats this morning. I'm not sure how much I believe them, but NVIDIA's market cap is up the equivalent of Tesla's market cap over the past 2 months, which is crazy.
Yeah.
And the other data point was that NVIDIA market cap is the same as the China stock market, the entire Chinese stock market. Again, I don't know if there's any truth to that. I have not validated those. Sure. But what scares me is whenever we see these parabolic moves, they tend to peak and come down pretty hard. And if that happens, I think that's going to really ripple through the rest of the market. We'll see growth in tech stocks come down pretty hard. Yeah. So I'm still fully invested, as I said before, but I'm sort of cautiously optimistic, but ready to make a move if we start to see some downside.
Nice. Well, thank you very much. I think we're about time to wrap this up. So I have to ask, do you have a favorite investment quote?
My favorite investment quote, I think I would go with, I don't know if it's a quote or a rule, but Warren Buffett always said, rule number 1, don't lose money. Yeah. Rule number 2, see rule number 1. So I changed that a little bit. Just don't lose a lot of money. That seems to be the killer for most investors, is protect capital, manage risk, and we'll all be better off in the long run.
Awesome. And then, of course, how does somebody get in contact with you? You've got that on that final slide, so thank you very much.
I do. My contact information is there. Feel free to reach out to me anytime. If you're interested in my weekly note, you can subscribe on my website. I put out a weekly note for people to read, shares my thoughts in the market. Really quick read, so feel free to do that. But thanks for having me.
Well, thank you for being here this week and being a great guest, and look forward to next week. I don't recall who the guest is, but we'll see you then. Thanks for being here.
See you, Ryan. Thanks.
All right. Thanks, Rob.